Were the markets even open today? That's seemingly what happened, but you wouldn't know by the price action. Things very, very quiet, very, very listless, but we do have, finally, a bit of event risk on the calendar in front of us and some macro themes to contend with as it approaches. See what it does to wake the markets from their slumber. I'm Ilya Spivak, head of Global Map here at tastylive. This is Macro Money. And what we are going to do here is take a look at, first of all, how we're setting up as the week progresses, look at what this performance looks like, then consider how it might fit into what comes next, because over the next 24 hours, we finally get the concept of a catalyst, to borrow a phrase. So let's consider here what's been happening so far this week. Stocks down, S&P 500 off by about 0.8%. NASDAQ off by about 0.7%. Rates higher across the curve. More on that in just a second. Crude oil still oscillating a little bit higher today after a small rise last week, but as we'll take a look at here in context momentarily, it's really just digestion after bigger moves. Gold down a touch again. The dollar up a bit with the yen so far taking the biggest hit, down just over 1%, and Bitcoin is still wiggling back and forth around its range top. But it's really the action in stocks and bonds that's perhaps the most interesting, and that's seemingly a change of pace from where we were last week. So just a quick reminder, this is how we did last week on the holiday shortened week there. And we can see here stocks up for a second consecutive week, albeit with less vigor. And that was mainly triggered by the U.S. jobs report that came a day early on Thursday, because, of course, Friday was the Independence holiday. And that data seemed like the markets took it at face value. The unemployment data was a little bit better than expected. The payroll data was a little bit better than expected. And so we can see the response is higher yields across the curve, in particular at the front end, suggesting that the Fed has less scope to cut rates in the near term. And stocks seemingly taking it in stride, saying, well, we don't need rate cuts if growth is good, right? So why worry? And stocks end up having a nice day higher. It is also the second lowest volume day for the year, so it didn't really take a whole lot to push the markets around, but the price action is the price action, so nevertheless, we do get a kind of good news is good news response, which of course starts to contrast with where we are as liquidity comes back this week. Yields are still going the same direction, though the long end is getting a little bit more life so far as compared to last week, where it was mainly about the short end. And stocks are looking soggy for it. So perhaps as we get more liquidity on the board, the conversation is changing. We'll see, of course, whether that's actually the case or whether the markets are just wiggling around, digesting after hitting record highs last week, as we get the first bit of news, and that is going to be minutes from the Fed's June policy meeting. Before we get there, let's just consider how the markets found themselves in this position. As we said, the jobless rate unexpectedly down, 4.1 versus 4.3. The economy adding 147,000 jobs to payrolls versus 110. So nominally better than expected result. But it's those low volumes that really start to jump out when you consider the actual internals of this data and how we arrived at these numbers. So first off, yes, of course, 147,000 is better than 110. And certainly that we got a 5K revision from 139 to 144K on the May number is nominally a step in a positive direction. But when we look at the net 2-month revision, covering both May and April, we can see that's 95,000 jobs to the downside. So did we actually end up with more jobs, or didn't we on net over a 3-month period when we got the June results? Okay, we got 37,000 jobs better at the headline versus consensus, and another 5K here. So that's 42,000 jobs better than we thought between May and June. But that's not even half of the 95,000 job downswing over both May and April. So did we end up with net more jobs? No, we ended up with net 50 plus K fewer. So not great news there. And when we look at what happened with the unemployment rate, this decline from 4.2 to 4.1% came not as more jobs were added, but as more people left the labor force and stopped being counted as unemployed. We can see the participation rate actually went down. That's what happens when people leave the labor force and are no longer looking for work. So their unemployment isn't considered unemployment as such, because in order to be unemployed, you have to not have a job but want one. And what we see here is a decline in participation that suggests this is not happening for labor market health reasons. This is happening for labor market shrinkage reasons. Again, not great. But in thin liquidity, with most of the institutional money off on the long weekend, we still get this. Now that that money is back, this is holding up, but we're starting to get this. This is where we conclude, okay, well, maybe what we're seeing this week is the right, quote-unquote, thing, and what we saw last Thursday is the wrong one. Perhaps. On to the FOMC minutes. We see from the statement at that meeting, not a whole lot going on here. The unemployment rate remains low, the Fed says. Inflation remains somewhat elevated. That is to say, is north of 2% by a touch. And we can see uncertainty about the economic outlook has diminished somewhat, if only through the passage of time. That is to say, when we rolled out the tariffs and the Fed looked at them and got concerned about what they might mean in March and again in May, we now see nothing has broken yet because, in large part, they've been delayed. So uncertainty about the economic outlook is necessarily a bit cooler because the immediate impact hasn't produced anything dramatic, but also it remains elevated because we still don't know what's going to happen. We see in the summary of economic projections that the Fed basically is continuing to run the narrative that they've been giving the market since March, which is to say, we know historically that tariffs are a problem for monetary policy because they weigh on growth but boost inflation, which demands, on the one hand, lower rates to boost growth, on the other hand, higher rates to contain inflation. So from the Fed's dual mandate perspective, if both of these things were to evolve simultaneously in those directions, it's a policy nightmare. There's nothing to be done. But from the Fed's perspective, we're sitting at inflation that's a touch above 2%, an unemployment rate that's a touch above 4%. Inflation is manageable and very close to target. The unemployment rate is low by historical standards. There's no need to make this decision. Better to sit back and wait for one of the sides of the mandate to start to flash red and to unmistakably say to the Fed, you need to go and focus over here, say on inflation or on growth. And in the meantime, the Fed is just adjusting its forecasts to say, higher inflation, March to June, that's the update. Higher unemployment, that's the update. Lower growth. But interestingly, fewer rate cuts. So we can see here between March and June, we go from, in particular, the back years of the outlook next year and 2027, and in particular in 2026, we see a shift from 2 cuts in March, 3.9 to 3.4 is 50 basis points. That's 2 standard cuts at 25 basis points apiece. We now go down to 1. We're still at 50 basis points for this year. In other words, the Fed is increasingly becoming a creature of the calendar. We're not looking like we're going to have a rate cut in July. In fact, we can see as much here. There's no change that's priced in. We look at September, and we can see the drift lower is starting to occur, but you don't get to any kind of meaningful rate cut probability until you get to October. So if the Fed is going to be at 50 basis points, it basically has to do those 50 basis points right here. Otherwise, it's run out of calendar to make those cuts. And so the Fed seems to be increasingly locked into this as time goes on. But for next year, they seem to think they can only do 25 basis points in easing because, again, they're waiting. And as the tariff deadline continues to push, it got pushed again this week from July 9th out to August 1st, apparently, on reciprocal tariffs. The knowledge of what the impact is going to be gets delayed right along with that. But as long as there is a cliffhanger on the horizon, the Fed doesn't know what all to make of all of this, is unable to extrapolate forward, and until then, something is going to break, either on inflation or the economy, that is on growth and on employment. Fed doesn't have the confidence to do anything at all. Hence the modest amount of easing next year. Now, what makes this very interesting is, of course, the other piece of data that we got last Thursday was the ISM report, which sort of tells the Fed's story. Manufacturing is narrowly in contraction territory. As ever, ISM is done in the same logic as other Purchasing Manager Index or PMI data, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. At 49 on manufacturing and 50.8 on services, kind of mentally scaling for services being a much larger part of the economy than is manufacturing, you sort of get the sense that the economy is about at or close to 50 on some sort of a cumulative assessment. In fact, if you assume that the economy is about an 80-20 split between services and manufacturing, then you get to a place where you might say, okay, if we scale it that way, and you end up with a reading of about 50.4, you have essentially standstill. If you do a straight line average between 50.8 and 49, you end up a little bit under at 49.9 or something along those lines. But We know the economy is more services than it is manufacturing, and so tilting it a little bit makes sense. Giving it the benefit of the doubt a little bit makes sense. But what that means is that essentially, since the end of last year into now this period, growth is at a standstill. At the same time, employment is contracting in both sectors and at an accelerating rate in June. Both of these indexes sub 50 and more so than were the previous month. And prices are rising. And at a very fast clip. We're back to near the levels where the inflation scare post-COVID was at some of its more dramatic levels before this big decline. So in some sense, this data is telling the Fed's story. In fact, after we got the jobs data, what we saw was the curve for where policy rates are going that we just looked at a moment ago. This is the curve for today, is now basically exactly in line with where it was on Fed meeting day, the 18th of June, having started the month a little bit more dovish. So indeed, it does look like the markets have interpreted the data as suggesting the Fed is not going to do much of anything that's different this year. When we look a little bit further downfield at next year, we open a yawning divergence. The market sees 66 basis points in rate cuts next year. That is 50 basis points in cuts, already fully discounted. So that's 2 cuts of standard size that are on the board, and about 16 basis points in the direction of a third 25 basis point cut, which gives that third cut a probability of better than even 64%. So the market envisions, as we can see here, 109 basis points in cuts between now and the end of next year. Compare that again with what the Fed is seeing, and there is a major disconnect. The Fed is at 75 basis points. 109 here is obviously a far cry from 75. It suggests the Fed is off by, or the markets are off, depending on who you choose to believe, by 34 basis points. That's about 1 cut and 9 basis points in the direction of a second one. So, needless to say, there is an important disconnect here. And of course, what we've been talking about is the bond markets are telling you where that disconnect is coming from. When we initially saw the rollout of the tariffs at the beginning of the year, this is January, so this is the start of this year. It's important to note here was the election. Clearly, the markets knew that there was some kind of a tariff regime that was coming. They did not mind it because they figured it was going to be not unlike Trump 1.0, which is not necessarily a thing that spooks the overall market, not something that's terribly destructive for growth. They didn't get concerned until here, when the rollout of the tariffs started to treat them as something else entirely. And so you got a parallel decline in the S&P 500 here in the yellow, as well as the 5 and 10-year break-even rates, measures of inflation that are baked into the bond market. And the logic makes sense. Consumer confidence and business confidence start to fall away with the rollout of the tariffs. There's clearly a growth scare. That's bad for earnings. And it's, of course, bad for the demand pull impetus on inflation. If there is going to be less growth, then there's going to be less demand chasing the supply of goods and services. That means price pressure on that supply will be diminished. All classic growth downturn indications. And so you get a very clear growth scare here. When you get sentiment snapping back, we can see here it's now come back and then some. Stock markets are actually higher than they were at the beginning of the year at this point. So we can see that whatever sentiment shift occurred here clearly tells you that when post-Liberation Day, the Fed and the markets saw the White House take a market signal and back away from the brink, you got sentiment coming back saying, okay, this is not going to be the kind of a thing that forcefully pulls apart the global financial order to the extent that it looked like it could at the height of the panic here. But notice these break-even rates, they've not budged from this range that they've since carved out from April's lows to the initial sort of rebound here into the beginning of May. They've remained locked near the bottoms here. They've not come back to retest these levels. This has not been a story of economic growth recovering by this metric. This has been a story of sentiment recovering, but of the story on growth still envisioning weakness downwind, because the markets have apparently concluded that the inflationary shock of the tariffs is something to look through. And the thing to focus on is what that shock then does to consumption and by extension to economic growth. They're calling for rate cuts, which is how you end up with 66 basis points on the menu for next year against the Fed's 25. And so when you get these minutes from the Fed, it will be very interesting to see how the Fed justifies what they're saying. And because we're probably going to get this familiar song and dance around inflation is contained or close to it, it's certainly not running away anywhere. Unemployment is relatively low. We don't need to do anything. We'll see if the markets still believe that story as generally benign. Because if the markets are becoming increasingly convinced that there is some kind of a growth scare on the horizon that the Fed should be responding to, and the Fed is pointed resisting, that's not going to sit well with risk sentiment. And what we are starting to see this week may well be, to bring it full circle, the story to keep an eye on. That is to say, rates are going to stubbornly resist, and stock markets are going to have to take the brunt of disappointment, because what the markets want is not that. They want the Fed to act. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be on in just 30 minutes' time, as I am every Tuesday, with Victor Jones for The Price of Truth. Back with Chris for Futures Power Hour on Friday. And back with Victor and Tom for First Call on Sunday, writing for the New Insights portion of tastylive.com and commenting on former Twitter and on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.